In this video, I want to talk about Carvana. They announced their earnings this past week, and the company surged 13% following the announcement of its second quarter earnings, which exceeded analyst expectations. The online auto retailer's performance was underscored by significant growth in the retail unit sales, which saw a 33% year-over-year increase. Now, it's been a fabulous 18 months or so, and since bottoming out at, this is crazy, $5, and now prices trading at $137. It really gave us multiple opportunities to get long. The first one was back in April and March of 2023 when price had this rally-based rally. Price comes back, takes out what was support, becomes resistance. As price moves higher, it forms another daily buy level. This rally-based rally, price comes back, dips its toes at the top of that zone, moves higher, forms a smaller buy level, more than likely on the 4-hour chart. At this rally-based rally, price comes back. So as you can see, as price continued to move higher, it gave multiple opportunities to get long. However, according to the monthly chart, the chart is suggesting takes them off the table at the monthly sellers level at 160. Now, to get into the actual results, CEO, founder of Carvana, his name is Ernie Garcia. He discusses the company's surprise profit and debt reduction plan on Bloomberg. The close, Carvana's net income in the period was $48 million, easily topping analyst expectations for a loss of almost $16 million.
It's a super basic question. What is driving the growth? What kind of income level? What kind of car?
Sure. Well, I think, since inception, we've sold cars across the credit spectrum, across the income spectrum, across the age spectrum. So we sell cars to American customers buying all the different types of cars that you'd expect them to buy. Our top seller right now is actually a Tesla Model 3, but we're also selling all the kind of small SUVs that you'd expect. So, we sell all the cars that customers want.
We also obviously track what's happening with the consumer in terms of auto loan delinquencies, credit card delinquencies, etc. Are you experiencing any impact from auto loan delinquencies? What are you seeing?
Sure. So as part of our business of selling cars to customers, many customers are looking for financing when they buy a car, and we provide that financing for them as well. So that gives us visibility into the health of the consumer on the credit side as well. And I would say, in general, there's nothing too notable to report there. I think there was obviously incredible performance from a credit perspective, post-pandemic in 2020, late 2020 and 2021. I think in 22 and 23, it probably drifted a little bit negative. Most lenders, ourselves included, tightened up credit quite a bit at the end of 23, and I think so far performance there looks pretty good. So nothing too concrete to discuss there.
When it comes to the demand side of this picture, Ernie, and what people want and what they're coming onto those lots to look for here, are you seeing any benefit here from consumer weakness, meaning the idea that people that might have been in the market for a presumably higher price, newer car are willing to trade down and go for a used car instead?
I think there's probably a ton of macro trends going on. I think affordability definitely drives that kind of behavior. So I think there's no doubt that's true. But I think, most importantly for us, we're trying to give customers the simplest experience we possibly can when they're buying a car. It's a totally new experience. They go to our website, they can click around in a couple minutes, they can find the car they love, choosing from tens of thousands of options. We'll deliver it to their door. They can get financing in seconds. They can sell a trade-in to us in minutes. And so we're offering a really different experience. And I think our focus has been on giving customers the best experience we possibly can, getting more efficient at doing that. And that drove incredible results that we're really proud of, really over the last 2 years. But I think this quarter in particular, where we were both the fastest growing automotive retailer and the most profitable automotive retailer, is, those are two boxes we're very proud to check.
Well, let's talk about fastest growing, because you and the rest of your executives got a lot of criticism over the last few years about the pace of that expansion. And of course, for a certain period of time, it decimated the stock, decimated it. Now, of course, we're looking at what could be probably one of the greatest comeback stories that we've seen for a publicly traded stock in decades. Yet you still got a lot to sort out. You got a lot of locations. Interest expense is still rising here. What's the message to investors here about making sure that this rebound does continue?
Sure. Well, there's a lot in that question. What I would say is I think If you look back at history at any companies that try to build anything that was differentiated, I think it's rarely a perfectly linear path, and it's generally very hard. We've been at this for 11 years. We've spent $10 billion trying to build a completely different supply chain. We've undoubtedly, made some great moves, and we've made some moves that in retrospect weren't perfect. But I think on average, we've always moved forward. And I think that the sum of those moves got us to this spot today, where we're the fastest growing and the most profitable, and not just the most profitable this quarter, but we had, this quarter we had the most profitable quarter of any automotive retailer ever. I think the position we're in now is incredible. I think the team that we have is incredible. Mm-hmm. I'm forever grateful for them for fighting through the last couple of years the way that they have. And I think from here, the opportunity is really large, right? We're in a huge market. We have a 1% market share, and we've got the team that knows how to go out there and tackle hard problems. So we're going to keep doing that.
If I'm looking at this correctly, your total debt, though, is still $6.2 billion. What are your plans for reducing it?
We'll reduce that over time. I think, this quarter we had $355 million in EBITDA in a single quarter, right? That starts to make that debt look a lot different than it may have looked a year or two ago. And I think if we keep having the gains that we expect to have, we'll keep accumulating cash, and we'll keep looking much better from a leverage perspective as well.
I mean, I hear your pitch, right? The issue is it seems like a lot of the analysts still have holds on the stock. So you clearly have a lot of skeptics out there. How do you assuage them of the fear of too much debt, and people are still worried about the fact that we'll actually make big purchases online?
I think in the real world, if you wait for everyone to cheer you on, you're going to be waiting a long time. So I think our job is to go out there and do the best job that we can. I think many analysts I think are pretty excited right now. Many analysts are completely fairly standing by and watching and trying to figure out where this is all going to go. Our job is to make as much progress as we possibly can, and so we're going to stay focused on that.
I am curious, though, when it comes to dealing with the debt load, as well as dealing with other obligations that you have here, any plans right now to go back to financial markets, whether it's equity sales or debt sales?
I think I'll try not to run back the whole answer I gave you before, because you called it a pitch, but which was reasonably accurate if we're being honest. But I think the most important thing is just that we keep making progress in the business. The team's done an incredible job. I think we're in a very different spot than we were a couple of years ago. I think that story is still a fair one, but it's a very different story today than it was back then.